All right, we're going to turn now to the retail sector. I guess there's one word in a way that describes the performance of the retail market over the last 12 months or so, and even till today, and that is resilient. We've seen around the country that despite many challenges to the sector, the interest from investors has continued to be high, and the trading activity in smaller centres has been pretty brisk, especially in Queensland. One of the drivers that we always turn to for some guidance about the future of this sector is retail turnover growth. And in Queensland, the light green bar there, you can see retail turnover in Queensland was over 7% not that long ago. I think this really does follow very closely the economy, and you see the rapid deceleration in the growth of retail turnover down to 2009, a year when, of course, the government stimulus package has really helped the retail market get through this year. Now, the forecasts are interesting at the moment because they're assuming that as that government stimulus starts to fade and interest rates especially start to rise, that there are still some challenges ahead for the retail market. Don't forget too that unemployment, even though the peak unemployment is now forecast to be much lower than originally thought, it still will rise slightly into 2010. So there are still some headwinds going forward for retail turnover in Queensland and indeed for the rest of Australia, and the forecast is a fairly flat year next year in Australia and fairly low growth in Queensland of about 1% in real terms, growth in retail turnover. So the interesting thing about retail, we touched on it earlier, is that population growth in household formation is very important to retail spending, especially in the area of bulky goods and the demand for goods to fill new houses. And what's happened in the last 12 months is that there's been a rapid decline in the amount of housing construction activity and housing starts. And some states are actually underperforming quite severely now. And, but what it is, it's latent demand has been building up all the time, that housing construction starts have been low. So we did a little bit of analysis to look at what the level of annual housing starts should be in each state and territory, and look at last year and this year, whether the construction activity would be below or above that long-term average. And it's fascinating to see what the result is. I mean, last year, New South Wales started to slip into this, underperformance, underbuilding, if you like, undersupply in the residential markets. But this year, it's become, it's forecast to be quite severe in New South Wales, the underbuilding, and Queensland will start to slip into effectively underbuilding given the level of population growth that continues to occur in Queensland. So this really does represent, by 2010, you'll start to see this turning around, and 2011 does take time to gain approvals and to get construction sorted. So by 2010, you'll start to see a lower level of undersupply. In 2011, hopefully be back closer to that zero there where demand is meeting supply. But the point is, for the retail market, this is going to be a very important boost to demand for household goods and for bulky goods especially over the next couple of years. The retail supply pipeline is actually quite mild. We've seen quite a bit of construction activity in the bulky goods sector. That's now slowing down at a time which is good because the demand for space, certainly in the next 12 months, will be lower. We're seeing a lot of DAs go in for extension of regional centres, and still some smaller centres in the form of neighbourhoods and bulky goods. But generally speaking, the construction activity is at a lower level and not a threat to the sort of the demand-supply balance in the retail sector. We have seen vacancy rates inch up, interestingly, in the Brisbane CBD in specialty stores. That's the blue line on this chart. We've seen a similar trend in Sydney and Melbourne as well, and we're seeing some massive redevelopment going on in CBDs, and I think for the medium term it's going to be really a positive thing. But in the short term, what tends to happen is that tenants are moving around as they get pushed out of centres under redevelopment, and it's causing vacancy rates to rise slightly. It's not really so much associated with an economic downturn as such. And you can see that the rents have actually continued, we think, to inch up, to slowly move up in the CBD retail areas due to the strength of the sort of retailer demand and the demand for retail to get back into that sector. The investment activity has dropped away in retail like other sectors, but you can see where successful transactions have occurred tends to be in the sub-regional, the neighbourhood and the bulky goods. All those sectors that are smaller lot sizes, if you like, where equity can be used rather than a reliance on lending from the banks. The yield pattern of the yield change is really the trend has been that smaller centres have have moved more and suffered greater value changes, perhaps anything up to 15–20%. But the bigger centres have moved very little. And you may see capital value changes as little as 3 to 5% in the major regional or the regional centres. So that's really been the pattern of change in pricing through the retail sector. Let's summarise that for a moment. The sector is the most resilient of all, although the outlook is still pretty tough for the retail market. The government stimulus packages are going to fade in terms of the direct handouts. The unemployment rate will rise some still in the next 12 months. Interest rates are probably the big unknown, just how quickly and just how high that will go, and we assume that will certainly take cash out of the household budget, less to be spent through the retail centres. But housing starts, watch out for housing starts because it represents a sort of pent-up demand area for the next 12 to 18 months. And it's really the stability of income streams of the retail sector, which has always attracted investors into the retail property sector and continues to do so despite the downturn in the economy.